In April 2026, an earnings report dropped that looked, on paper at least, like a pretty slight financial miss.
Yeah, a slight miss, but definitely a miss.
Right. But if you read the footnotes, you'll find a direct hit cyclone, a severed global waterway, and a desperate scramble for the metal currently holding the device you are listening to this on.
Oh, it is just a phenomenal case study. I mean, it really shows how global supply chains actually function under extreme stress.
Welcome to the deep dive. Our mission today, for you listening, is to crack open Alcoa's Q1 2026 earnings call transcript and the slide deck that goes with it.
Because there's a lot hiding in there.
Exactly. We're going to look at how a single, seemingly mundane commodity connects geopolitics, extreme weather events, and, the hidden mechanics of the modern economy.
It really touches everything.
It does. So let's set the table with the foundational financial baseline from this report. In the first quarter, Alcoa reported $3.19 billion in revenue and an adjusted earnings per share of $1.40.
Which, just for context, Wall Street analysts had expected $3.35 billion in revenue and $1.60 in earnings.
Right, so we are looking at a miss on both the top and bottom lines.
Yeah, a miss that usually, sends investors running for the exits.
Or at least forces management into a highly defensive posture on the earnings call.
Oh, for sure. You'd expect them to be sweating.
But I'm reading through this transcript, and they aren't defensive at all. If anything, they are swaggering.
Yeah, they really are.
I mean, they are sitting on a massive $1.4 billion cash pile. They pulled in $595 million in adjusted EBITDA.
Which is essentially their cash profit from operations.
Right. And instead of hoarding that cash during a supposed miss,
Yeah.
they are aggressively paying down their debt.
Yeah, they actually issued a notice to redeem $219 million in 2028 notes early.
Okay, let's unpack this. If I'm a Wall Street analyst looking at missed Q1 targets, I'm panicking. Why aren't they?
Well, because that financial miss wasn't a failure of execution. It was a direct collision with, frankly, world historical events.
So it wasn't just bad management.
Not at all. To understand the numbers, we have to move out of the boardroom and look at the physical reality of the raw materials.
Okay.
Specifically, we need to focus on Alcoa's alumina segment.
Right, because before you have the finished aluminum, like the metal frame of a car and airplane fuselage, you have to mine bauxite ore.
Exactly.
Yeah.
And then you run it through a refinery to create this fine white powder called alumina.
And the first quarter of 2026 just delivered a brutal combination of events for that specific powder.
Brutal is the right word. It completely fractured the global alumina supply chain.
Starting with the Middle East, right?
Yeah. On February 27th, the escalation of the Middle East conflict effectively restricted transit through the Strait of Hormuz.
Which is a staggering disruption when you look at the raw tonnage.
It's massive.
The sources note that normally 8.8 million tons of alumina and 6 million tons of bauxite flow through that strait every single year.
And suddenly, that massive artery is just severed. Ships are forced to halt, reroute, or sit completely idle.
Just a logistical nightmare.
Totally. And right as the logistics network is trying to absorb that shock, Cyclone Narelle takes a near-direct hit on Western Australia.
Oh, wow. Western Australia being the beating heart of Alcoa's global mining and refining operations, right?
Exactly. The cyclone tore through the region and severely disrupted the local gas systems.
And they need that gas for power.
Huge amounts of it. It provides the massive amounts of energy needed to run the refineries.
Unbelievable.
It also created absolute chaos for vessel loading at the ports. You had ships unable to dock, power fluctuations at the plants, just a global supply chain suddenly paralyzed on 2 different continents.
Wait, I'm confused here.
Yeah.
If alumina is suddenly in massive short supply globally because of a closed strait and a cyclone, shouldn't Alcoa be able to charge an absolute fortune for whatever powder they do manage to produce?
You would think so, yeah.
I mean, why did the alumina segment's adjusted EBITDA drop by $52 million sequentially? They actually lost money on this.
It seems counterintuitive, I know. But you have to factor in the physical realities of moving millions of tons of material.
Okay, break that down for me.
Well, when you can't use the Strait of Hormuz, you have to reroute massive bulk carrier ships. That adds weeks to a journey.
Which means more time on the water.
Right. And the daily charter rates for those vessels spike, insurance premiums go through the roof, and you are burning thousands of extra gallons of incredibly expensive marine diesel.
Oh, that makes sense.
Meanwhile, in Australia, the disrupted gas supply means they had to rely on alternative, more expensive fuels just to keep the refineries warm. The costs of mining and shipping simply exploded.
It's like, think about a massive commercial flour mill.
So,
A severe blizzard shuts down the main highway connecting the mill to the nearest major city. The mill has silos full of flour, but the delivery trucks are stuck burning expensive fuel on unplowed back roads.
that's a great way to picture it.
The city's bakeries are starving for flour, but the mill is bleeding cash just trying to force the logistics to work.
Exactly. And we have to take that analogy a step further to explain the most bizarre detail in this report.
Which is?
The global benchmark price for alumina actually fell during this crisis.
See, that completely boggled my mind reading the data. How does the price drop during a massive supply crunch?
Because of where that stranded material had to go. Those ships full of alumina couldn't get into the Middle East.
And they are a huge buyer, right?
They are the world's largest importing region for this powder. But bulk carrier ships cost a fortune to operate every single day.
You can't just park them in the ocean.
Right, you can't just have them floating aimlessly in the Indian Ocean.
Uh,
So those cargoes were desperately rerouted and dumped into the closest massive market that would take them.
which was China.
Exactly, China.
So going back to the analogy, the flour trucks can't reach the major city. They turn around and they dump all their flour at the only small town bakery they can reach just to empty the trucks.
Yep.
Suddenly, that specific town is drowning in flour and the local price crashes.
That is exactly what happened. That sudden influx of diverted alumina temporarily flooded the Chinese market, pushing the global index price down.
Wow.
So Alcoa is getting hit on both sides. Their freight and fuel costs are skyrocketing, while the market price for their product is simultaneously dropping because of this forced rerouting.
And the downstream effect of this is massive. The sources note that roughly 4 million metric tons of refining capacity in China was curtailed in the first quarter.
Yeah.
And nearly 2 million tons of refining capacity in the Middle East went offline.
And we should probably define what curtailed means in this heavy industry context.
Yeah, it's not just a minor slowdown.
No, it doesn't just mean they slowed down a little. It means they had to physically throttle down or entirely shut off massive industrial operations.
Which is a huge deal.
It is. The raw dirt either couldn't get in or the energy required to process it became too expensive, so they had to pull the plug on millions of tons of capacity.
So if the raw powder can't leave the Middle East or get into the Middle East, what happens to the massive smelters inside that region that rely on it? They must be completely starving for it.
They are. And that brings us to the finished product side of Alcoa's business,
Right.
which went into hyperdrive as a direct result of this exact same crisis.
Because the Middle East makes a lot of the actual metal.
Exactly. The Middle East doesn't just import the raw powder. They use it to operate some of the largest aluminum smelters on Earth. They are the biggest exporting region of finished primary aluminum.
So the raw materials couldn't get in, which
Yeah.
means the finished metal couldn't get made, and therefore it couldn't get out.
Spot on. More than 2.5 million tons of annual smelting capacity in the Middle East went offline because they simply didn't have the ingredients or the stable logistics to keep running.
That is a massive chunk of global supply.
And the global market was already incredibly tight before any of this happened. Inventories were sitting at historic lows. So when you suddenly subtract 2.5 million tons of supply, the price of finished aluminum goes ballistic.
I saw that. The London Metal Exchange, or LME, aluminum prices spiked 10% sequentially.
Yeah, pushing well past $3,600 per metric ton.
Here's where it gets really interesting. This is where Alcoa's management made a highly calculated gamble.
Oh, this was such a bold move.
Right. In the first quarter, right as this chaos was unfolding and prices were climbing, they intentionally repositioned 30,000 metric tons of aluminum inventory in North America.
Yeah.
They basically parked it in a warehouse and refused to sell it.
They looked at the market, saw the massive supply crunch coming out of the Middle East, and decided the current Q1 prices just weren't high enough.
So they just held the metal back.
Exactly.
It reminds me of a vineyard holding back a vintage wine, like a winemaker sees a massive frost wiping out European grapes.
Okay, yeah.
Instead of rushing their current bottles to market to hit their quarterly sales targets, they just lock the cellar doors. They take a short-term hit on their financials, wait for the global shortage to really bite, and release it later for a windfall.
Which completely explains why Alcoa missed their Q1 revenue targets.
Right. They literally chose not to make the sales.
It's a compelling comparison, but, with a vineyard, the wine actually gets better as it sits.
That's true.
Sitting on 30,000 tons of industrial metal is incredibly punishing. We are talking about roughly 1,500 tractor-trailer loads of aluminum.
Oh man, where do you even put that?
Storing that requires massive warehousing space, security, and complex logistics, all of which burn cash. It was a massive financial risk.
Because what if prices drop?
Exactly. If the Middle East supply suddenly came back online or global demand unexpectedly cooled, Alcoa would be stuck holding heavily burdened inventory.
But they read the geopolitical tea leaves perfectly.
They really did.
The CFO, Molly Bierman, stated in the call that pushing those sales into the second quarter, combined with higher expected prices, is projected to provide a $55 million favorable benefit.
That is a huge payoff.
They traded a minor Q1 optical miss for a massive tangible Q2 gain.
It requires immense discipline to intentionally miss a Wall Street target because you trust your read of the physical supply chain more than the quarterly expectations.
And it isn't just about the base price of aluminum rising, is it? The source material highlights a severe regional desperation, particularly around something called value-add products, or VAP.
This is a crucial distinction. We often think of aluminum as just generic blocks of metal.
Like silver bricks.
Right. But manufacturers don't want generic blocks. They need billet, slab, and foundry products.
Which are what exactly?
These are highly specific, engineered shapes and alloys that are designed to be dropped immediately into an automotive assembly line or an aerospace manufacturing process.
Okay. And North America currently relies on the Middle East for roughly 50% of its aluminum imports.
And Europe is similarly dependent.
So when those manufacturers realize the shipments of these highly specific billets aren't arriving, they don't just gently look for alternatives, they panic.
Completely. Because an assembly line shutting down costs millions of dollars an hour.
They bleed money.
Manufacturers will pay almost anything to secure that metal. This is reflected in the regional premiums.
You can explain premiums?
Yeah, a premium is the extra cash a buyer is willing to pay completely on top of the base LME price just to guarantee physical delivery to their specific region.
I'm looking at these premium numbers, and they are staggering. The Rotterdam premium jumped 55%.
Insane.
And the Japan premium spiked 104%. They are paying more than double the standard premium just to ensure they have the metal to keep their factories running.
And this is where Alcoa leverages what they call their flexible cast house network.
I saw that phrase. What does that actually look like in practice?
Okay, so a smelter produces liquid aluminum. The cast house is the facility attached to the smelter that takes that liquid metal, mixes in specific alloying elements, and casts it into those highly engineered VAP shapes.
Right.
Because Alcoa has a robust network of these cast houses spread across North America and Europe, they aren't reliant on a single bottleneck.
So they can adapt.
Exactly. They could rapidly pivot their operations to churn out the exact billets and slabs that desperate stranded buyers needed. They stepped in to capture those massive premiums right in their customers' backyards.
So they are capturing enormous price spikes for their finished metal. But we were still operating in an incredibly inflationary environment.
Oh, very much so.
The Middle East conflict pushed up global oil prices, marine freight rates are through the roof, and domestic labor costs are rising.
Everything costs more.
How is Alcoa managing to keep its actual production costs from eating up all the new profit they're making on these premiums?
To understand how a modern industrial giant defends its margins, you have to look at its ultimate vulnerability. And for an aluminum smelter, that vulnerability is energy.
Smelting aluminum is famously energy-intensive. It's often described as packaging solid electricity.
I love that phrase, solid electricity.
Right. You take the white alumina powder, drop it into a massive pot of molten salts, and pump an astonishing amount of electrical current through it to break the chemical bonds and separate the oxygen from the aluminum.
Exactly. Now, if you are a company whose absolute primary cost is electricity, operating in a world where energy markets are incredibly volatile due to global conflicts and supply shocks, you are in a highly precarious position.
Because power prices swing wildly.
Right. If you are buying power on the spot market, you are basically paying whatever the going rate is that day.
Right. If a war breaks out or a pipeline shuts down, a competitor's electricity bill might triple overnight.
Which would destroy their margins.
Which makes the statistic shared by CEO William Opplinger so incredible. He noted that Alcoa has less than 1% exposure to spot electricity prices globally.
Less than 1%.
That's crazy.
It is a massive structural moat. While competitors are getting crushed by sudden spikes in the power grid, Alcoa's energy costs remain essentially flat.
So they just pocket the difference.
Their margins on the finished metal simply expand as global prices rise. because their underlying production costs aren't moving.
How do you even achieve that on a global scale? You can't just ask the power company nicely to not raise your rates for a decade.
No, you definitely can't. You do it through rigorous, long-term contracts and complex financial hedges.
How much is hedged?
The company details how 99% of their energy is locked in. For example, the natural gas they use to power their San Ciprian facility in Spain is completely hedged out through 2027.
Meaning they've entered into financial agreements that guarantee a fixed price.
Exactly.
If the actual market price of gas spikes in Europe, the financial instrument pays out the difference, keeping Alcoa's net cost exactly the same.
Exactly. And on the direct electricity side, they just renewed their power contract for their Messina facility in New York for 10 years.
10 years!
With options to extend it for 2 more 5-year increments. They have methodically isolated their largest input cost from global volatility.
The mention of that Messina site in New York brings up another detail from a report that I found absolutely wild.
Oh, I know what you're going to say.
It's the real estate pivot.
The monetization of their idle assets, right?
Yes. Alcoa has several older smelting sites that are fully curtailed. They've been shut down for years. Messina East is one of them.
Yeah, they're just sitting there.
But they aren't just letting these massive old industrial plants sit there gathering rust. The CEO mentioned they are in advanced talks to monetize the former Messina East smelter site by selling it to a data center developer.
Which is just a brilliant synergy when you think about the underlying infrastructure of an old smelter.
Right, because what does a legacy aluminum smelter have? It has massive industrial scale, high voltage connections directly to the electrical grid.
And what does a modern AI data center need more than anything else? Incredible, uninterrupted amounts of electricity.
Trying to build that kind of grid connection from scratch for a new data center takes years of permitting and hundreds of millions of dollars.
But Alcoa already owns the plug.
It is fascinating to watch a 130-year-old heavy metals company effectively playing the commercial real estate and tech infrastructure game to generate cash off a site that hasn't produced metal in years.
It demonstrates an agility to extract value from every corner of their portfolio, rather than just waiting for commodity cycles to turn in their favor.
So what does this all mean? We started this deep dive looking at a company that ostensibly missed its Q1 earnings targets.
Right.
But when you look past the top-line numbers, what you actually find is a masterclass in global risk management.
Truly.
They absorbed a direct hit from a cyclone in Australia. They navigated the sudden closure of one of the world's most critical shipping lanes without entirely stocking out of supplies.
They took a massive calculated risk, holding back 30,000 tons of inventory to perfectly time a Q2 price spike.
And they isolated 99% of their energy costs from global inflation. And on top of it all, they are selling old factories to AI companies.
They aren't just surviving geopolitical chaos.
No.
Their business model is structurally designed to profit from it.
And that level of execution doesn't happen by accident, does it?
Definitely not. The defining quote of the entire earnings call came right at the beginning, when the CEO stated, "Safety is not an initiative. It's the foundation of everything we do."
Which sounds like corporate speak, but
But in a macroeconomic environment defined by conflict, supply chain fractures, and extreme weather, having absolute operational discipline at the ground level is what creates strategic agility.
it's the bedrock.
Exactly. Making sure your leaders are on the plant floor, keeping your workforce safe, and rigorously maintaining your equipment ensures that when the market suddenly demands a massive pivot, your facilities can actually deliver.
You can't execute a pivot if machines are broken.
You cannot outmaneuver a global supply chain crisis in the boardroom if your factories aren't running safely and reliably on the ground.
Operational discipline is the foundation that allows them to play this high-stakes strategic game. Which leaves us with a final thought for you to chew on as you go about your day.
Yeah,
We rarely think about the aluminum that physically surrounds us.
it's everywhere.
The soda cans in our fridge, the frames of our cars, the chassis of the laptop or smartphone you might be interacting with right now. But this deep dive proves that this everyday, seemingly boring metal is actually a proxy for global stability.
It really is.
Think about it, if the restriction of a single strait in the Middle East and one storm off the coast of Australia can radically alter the cost, movement, and availability of the basic building blocks of our modern world, what other fragile, entirely hidden dependencies are built into the mundane objects sitting on your desk right now?